Welcome to the Rural Classroom Plus. This is Steve Barton, and thank you for tuning in. We'll be taking your questions and asking Rick himself. If you're watching on YouTube, X, or any other outlet, we'll be pulling the questions from the Rural Classroom Plus. So head over there using the links down below or go to ruralclassroom.com. Rick, how are you, sir?
I'm well, thank you. The better for being on with you in front of the classroom members. Thank you for being here.
Yes, pleasure's all on this side of the table, sir. Do you have any opening thoughts? Anything you want to start off with?
A few, actually, 2 commercials, which people will have to suffer through. The first is that this Saturday, we are doing part 2 of the Rural Bootcamp around gold and gold investing. The first one, about 3 months ago, was about the reasons why one should invest in gold, really well timed. And the way to affect physical ownership of gold. The second one, which will air this Saturday live, will be about the senior gold stocks. The final one, in about 3 months' time, will be about more speculative gold stocks. This sequence occurs because that's the sequence that a gold bull market occurs in. Gold bull markets, or precious metals bull markets, frankly, are always led by gold. And I would suggest, well, one could argue that gold has been in a bull market, of course, since the year 2000, when it was at $250. But the more dramatic part of the gold bull market, I would suggest, began in 2023. We've seen a nice move in the gold price, and we saw a move in the gold price that wasn't accompanied by a move in the gold equities. This, too, is typical of gold bull markets. Just in the last 13 weeks, we've seen a flow of funds into the gold equity ETFs. So we're now in the beginnings of a gold equities bull market. Gold equities bull markets occur after leadership has been established by the gold bullion, and after the gold bullion has risen enough that the selling price of the product is increasing faster than the cost to produce it. We're seeing just that with blowout quarters from gold producers, and the market is noticing. The gold stocks are starting to run. What we're going to talk about this Saturday is the best of the best gold companies, the companies that should be expected to outperform the market with less risk in the next year or year and a half. That will be followed in 3 months by a discussion of speculation in gold equities, because in the middle and the end of the market, the bottom end of the gold market moves the fastest. The small gold companies, the developers, the explorers. So we let off with gold. On Saturday, we're doing gold as an investment. In 3 months, we're going to do gold stocks as speculation. That's the Rural Bootcamp. Remember that this bootcamp is meant to be used in conjunction with the Rural Classroom. We're talking about product-specific topics in the bootcamps. They're 8-hour-long deep dives. They are meant to be used. These educational deep dives are meant to be used in conjunction with the general how-to programming at the Rural Classroom. I would encourage members of the Rural Classroom to have discussions amongst each other about the contents of all of these recordings, the general how-to sessions, but the boot camps in particular. Remember, there are thousands of you, and thousands of minds working together work better than one mind acting alone. So by all means, attend the boot camp, use it in conjunction with the other services of the Rural Classroom, and compare and contrast the lessons that you've learned with your fellows at the classroom. And then I'd like to urge all of you to attend live or via live stream the Natural Resources Investment Symposium, July 7 through 11 in Boca Raton, Florida, or for most of you, via live stream in the comfort and convenience of your own home. This will be, I'm absolutely convinced, the best conference that we've ever done, which is saying something, because we've done some pretty good conferences. Here's why. Spectacular big picture thinkers, spectacular macro. And when I say spectacular, I'm not talking about some failed newsletter writer. I'm not talking about some flunky journalist. I'm talking about people like David Stockman, former director of the Office of Management and Budget, who wrote a book called The Triumph of Politics, describing the derailment of the Reagan Revolution for smaller government and talking about the problems with Trump's efforts to do the same. not a failed journalist, but rather somebody reporting from the belly of the beast. Nomi Prinz, talking about the corrupt structure of Wall Street from the point of view of a former Goldman Sachs partner. Again, not some flunky journalist, but rather somebody who lived in the game, somebody speaking from the belly of the beast. Daniela DiMartino Booth will talk about the Fed. Why should she know something about the Fed? Because she was a researcher at the Dallas Fed. The list goes on and on and on. After we're done with the big picture thinkers, after we've told you about the way the world is, not the way mainstream media would like you to believe it is, we take you to portfolio managers and analysts who have operated in natural resource businesses for 30 or 40 years. Not somebody who flunked crypto, not somebody who failed as a supermarket analyst, not somebody who went broke with pot stocks, but rather people who have spent decades making money in natural resources and precious metals in good markets and bad. We have the living legends, people who have built multi-billion-dollar mining companies from scratch, telling you how they did it, telling you about the mistakes they made, telling you how they enjoyed success, and telling you how they identify success, telling you specifically how to identify 10 million market cap or $25 million market cap companies that could be 2 billion or 3 billion or 5 billion market cap companies. Again, from the belly of the beast, not people who talk about it, people who have in fact done it. Steve, at every other investment conference on the planet, the qualification to be an exhibitor is a check that cashes. The conference sponsors regard the exhibitors as advertisers. My attendees have told me for 30 years that my exhibitors are content too. The consequence of that is that every single exhibitor we have is vetted. Every public company exhibitor needs to be owned in accounts owned and managed by the conference sponsors. As you've heard me say before, Steve, there's no guarantee because I own a stock it goes up. But there's an absolute guarantee that every exhibitor that you see on the floor at the Rural Investment Symposium has been vetted. No other investment conference on the planet that I'm aware of can make that claim. All of these things allow me to make the following value proposition to my attendees. Whether you attend the conference live or via live stream, first of all, you will have access to 50 hours of programming, more than you could possibly consume, but you'll have it recorded so that you can review the conference for 12 months' time. All of you will have access to the interviews that I've done before the conference so that you can allocate your time more efficiently at the conference. But finally, for all of you, because of my confidence in the quality of the conference, if any of you attend the conference, live or via live stream, and you're not completely satisfied with the result, I'll refund your tuition. Absolute money back guarantee. There is no other investment symposium on the planet that I'm aware of that has a 100% satisfaction guaranteed or money refunded. Now, you're going to get out of the conference what you put into it. Before the conference, listen to my interviews of the speakers at the Rural Classroom. Listen to my interview of the exhibitors at the Rural Classroom. Allocate your time at the conference efficiently. Remember, at the conference, you'll have 50 hours of programming in 4 days. That means you have to take notes. You have to know ahead of time those subjects which you need to know more about and those subjects which you feel that you don't need to know more about, so you can allocate your time efficiently. Remember then afterwards to participate. Play the tapes again and remember that there will be discussions about the conference for a year at the Rural Classroom where you can compare and contrast notes with your fellows. Assuming you've done the work, or even if you don't do the work, remember that there's an absolute solid gold money back guarantee. If for any reason you aren't satisfied with the content that you received, you won't pay. We'll refund the money. So, Steve, after those two commercials, blatant commercials, both of which are completely factual, by the way, let's talk a little bit about where we are in the market. A few interesting things. First, the deliberate attempt, failed attempt in this case by the Fed and the political class to lower the interest rates has been interesting for many reasons. Even their measure of inflation, the CPI, which I, by the way, call the CP-lie, has been stubbornly high, and they have been unable to lower the interest rates. But much more interestingly, despite some success in the short treasury, in short dated interest rates, the long dated interest rates continue to climb. And the long dated interest rates continue to climb even in the face of fears of the overall economy. The so-called flight to value isn't occurring in the US 20. It isn't occurring in the US 30. The dichotomy in interest rates between the soft short rate and the very, very, very strong long rate is saying, I think, or perhaps at least, that the Fed is beginning to lose control of the interest rate battle. That fears about the declining purchasing power of the US dollar are beginning to overwhelm the attempts of the Fed to manipulate the interest rate lower. If this is true, this is a shadow of 1975. It's something that I have seen before, and it has profound implications for debt markets, for equity markets, and in particular for precious metals markets. We're seeing something else too, Steve, evidence of a dramatically slowing economy. I don't think there's any doubt about where I stand with regards to tariffs. Tariffs are taxes, and taxes are bad. But we are starting to see the impact of trade uncertainty. We're starting to see the impact of economic nationalism, not in the United States necessarily or solely, but around the world. And what we're starting to see is that the economy is slowing. The precipitous decline in the oil price had nothing to do with an increase in oil production. We haven't seen that. It's had to do with a reduction in oil demand. And that is a wonderful sign of a soft economy. We are now coming into a period where interest rates would appear to be strong, at least on the long end of the curve, in response to inflation. But even despite inflation, the economy is softening, which is to say the inflation isn't occurring on the demand side. It's occurring somewhere else. They had a name for this in the 1970s. It was called stagflation. It was not pretty. Those of us who paid attention got through it handsomely. Those who didn't got punished severely. It's our job at the Rule Classroom to help you be one of those who get through it healthily rather than otherwise. We talked, Steve, the last time you and I visited on the classroom about the arithmetic behind this. And the arithmetic behind this is fairly stark. We talked about the on-balance sheet obligations of the U.S. government, the off-balance sheet obligations of the U.S. government, and the fact that the last time that we faced this dilemma in the 1970s, the U.S. dollar lost 75% of its purchasing power over 10 years. And not coincidentally, gold did very well. Now, this doesn't happen in lockstep. Things don't go straight up. They don't go straight down. They happen in staccato fashion. There's a lot of volatility along with the cyclicality in these markets. But people need to prepare themselves for the fact that the underlying investment themes have changed. I would suggest to you that we had one predominant investment theme in the period 1982 to 2022, which was prosperity, globalization, lower interest rates. We have a very different circumstance now. And for that circumstance, while the circumstance that we're in today won't be exactly like the 1970s, you need to begin to prepare yourself for slower economic growth, less buoyant equity markets, very, very, very troubled debt markets, a more challenging business climate, and I would suggest to you, very strong precious metals prices, and later, stronger natural resource prices. I think that's a pretty good introduction, Steve, to the conversations that will follow as a consequence of the questions that our audiences ask.
Okay. I will back up what you said about the boot camp. Like all your boot camps, I've attended all of them. They're very good for our brokerage accounts. The symposium in Boca Raton was a blast last year. That was my first time going. I've already got my tickets and everything for the next one. I cannot wait. As far as macro thoughts here, you see that it looks like the Fed is losing control. And you can see that in their posted Fed funds rate. And then when you look out on the 20 and the 30 and, according to the U.S. benchmark, the 10-year treasury. And that's just an aspect of people are, they have a fear that the dollar is losing purchasing power, which it is. You see the oil prices are going lower, but that's not necessarily because it's because there's less demand, which is a really good forecast of a coming recession. You see a type of 1970s style stagflation, which is lower growth, increased unemployment, meaning more people are unemployed, and high inflation. And things that typically do really well in that environment are precious metals, and things that are extremely stressed in that environment are debt markets.
Yeah, the long bond is not a good place to be in stagflation in particular. Imagine yourself in the decade of the 70s when, as an example, the prime rate nearly quadrupled, somewhere between triple and quadruple. Imagine yourself owning a treasury, a 30-year treasury in 1970, yielding 4. Imagine the price of that treasury when the current treasury yield is 15. It's extremely unpleasant. What that means is that you lost 75% in your riskless asset. Never mind that, the yield that you get from it has declined by 75% in purchasing power. Talk about a double whammy. I'm not saying that the bonds are going to zero. I'm not saying don't own any bonds. I'm saying shorten your maturities dramatically. Do not chase yield by going out the yield curve. Absolutely, positively do not do that. If you have a bond portfolio, a legacy bond portfolio, and for any reason you don't want to liquidate some of that portfolio, you don't want to pay capital gains tax, whatever, absolutely, positively hedge that bond portfolio with gold.
Okay. All right. If that doesn't perform, then gold should, and you'll at least it'll be a wash. Okay. Should we start getting into some of the questions here, Rick?
Let's do it.
All righty. Okay, this one is from Eduardo, and Helen backed it up. They are curious about the recent drastic drop of sovereign metals below its capital raise price. In your view, are there any fundamentals supporting this drop, or is this just a massive opportunity for those not able to participate?
We're in a winner-takes-all market, and the truth is that natural resource money is flowing towards gold and away from everything else. I've been a steady buyer of the tier 1 deposits in out-of-favor commodities, including sovereign. Now, it could be that the drop in price reflects some institutional investors as to the aspirations of Rio. There may be some people that own sovereign that were owning sovereign because they expected an immediate takeover bid from Rio. Ironically, although I wouldn't mind getting paid sooner, the fact that they, at least in the near term, aren't going to be taken over by Rio seems to me to be pleasant. I own sovereign because I believe that if they are still an independent public company, i.e. haven't been taken over for 5 years, that there's a real chance that I enjoy a 10-bagger. So for me, the softness in sovereign, in Centaurus, in the whole range of very large tier 1 deposits in out-of-favor materials, they are all soft, and I am delighted by that softness.
Okay. Tibor Simon has a similar question. He's asking about meteoric. He says, I'd like to get your take on some of the rare earths. So we just talked about a couple of them. Rare earths that will become irrelevant in 5 to 10 years from now because of how fast technology is advancing forward. Should we be looking at what deposits are you looking at?
I don't know enough about technology to either corroborate or dispute the gentleman's thesis. What I have learned about industrial materials is as they come down in price, if they come down in price, there are more and more utilizations, more fabrication. I remember having the discussion around cobalt some years ago where the person from General Motors told me that if there was stability of supply in cobalt, that the fabrication use would increase even in the face of higher prices. And my suspicion is, given the various utilizations of rare earths, to the extent that fabricators could be assured of supply, that is, if the fear of Chinese sanctions, as an example, went away, the utilization of rare earths in a variety of industrial capacities would increase. Make no mistake, I'm not suggesting to people they have 100% of their portfolio in materials that they can't pronounce. What I am suggesting is that the technology revolution is still very much underway, and the technology revolution in terms of the gadgets that we use, the microphone I'm speaking on, all the stuff that makes the neutrons and stuff that are enabling this conversation to take place, all of this requires rare earths. And in addition, well, there's 2 things around rare earths that people need to know. One, they aren't very rare, but we haven't looked for them because the Chinese have produced them so cheaply. One of the reasons that the Chinese have been able to produce them cheaply has been the environmental standards around rare earth production in Western China have been horrific. And both the Chinese government and the Chinese people have resolved not to continue this type of process. So that although the Chinese may continue to be the lowest cost producer, the costs of producing rare earths in China are escalating. At the same time that is happening, increased levels of resource nationalization mean that non-Chinese fabricators are beginning to look for non-Chinese sources of rare earths. And that's where this discussion takes place. Companies like Hecla, companies like Meteoric, perhaps processors, represent, I think, a unique opportunity. These are speculative, to be sure, because they require advances in technology, or at least the maintenance of existing technologies. This isn't the place where you want 100% of your portfolio. This is definitely the place where you want 2.5 or 3% of your portfolio. And most people's portfolio presentation in terms of rare earth representation, is zero.
Yeah. Okay. This is new to me. This is from Bertram. He says, Rick, do you have any concerns about Exxon's apparent shift toward net zero goals in support of government carbon regulation? I hadn't heard about this. Have you?
I'm not familiar with it either.
Okay.
I do remember when BP said that their new slogan was Beyond Petroleum, and they asked Exxon at a meeting about that, and the guys at Exxon said, "We're an oil company." I thought that was a really good answer.
Yeah.
When I look at Exxon over 30 years, what I see is an absolutely superb deployer of capital. I see a company that when there haven't been suitable investment opportunities, they've distributed cash back to shareholders, either by way of dividends or share buybacks. I see a company when the industry is out of favor that's become an absolutely aggressive investor. I see a company that's maintaining their sustaining capital investments when the industry as a whole is deferring $1 billion in sustaining capital investments a day. I see the biggest oil company in the world making a discovery in Guyana that moves the dial even for ExxonMobil. I see a company that has, as a consequence of their declining number of Class A Tier 1 locations in West Texas, spend $60 billion buying Pioneer to integrate Pioneer's land package with their own and increase their dominance in that basin. Could Exxon go lower from here? Of course, as the oil price declines, their upstream free cash flow declines. Will I be happy owning Exxon 6 months from now? Maybe, maybe not. Will I be happy owning Exxon 5 years from now? No, I won't. I'll be ecstatic.
Okay. I've got 5% of my personal portfolio in Exxon, and even at these price points, I'm thinking of upping that to more. Very tempting. Han wants to know, he says, hi, Rick, can you comment on Cerro de Pasco and Equinox Gold latest earnings released? What ranking do you currently give them?
The Equinox earnings release was problematic from my point of view. I had hoped that the ramp up of their new Ontario production would be faster, and the cash generation from that deposit, never mind the earnings, which were disappointing, the cash generation from that deposit was problematic. It is a fact, and we've talked about this before at the classroom, that the construction of that project meant that Equinox deferred sustaining capital investments elsewhere in their portfolio, and that's caught up with them. They need to maintain sustaining capital investments elsewhere, even as they ramp up Ontario. This was a lousy quarter, despite any attempt to make it appear less lousy. I continue to believe that they will achieve nameplate capacity in Ontario. And if I'm right, if they obtain nameplate capacity on Ontario, the quarterly earnings are going to be blowouts. But more work is needed to be done at at Equinox. The first is that they need to continue to work to get that mine and mill operating at design capacity, get the all-in sustaining capital cost down, get the mine working efficiently. The second thing that they need to do, and Ross Beatty has done this for years when high quality assets come on, is they need to sell some of the lower quality assets. They need to do what Newmont just did. The starter kit assets that they did, perhaps Castle Mountain, perhaps Los Filos, the lower quality assets, which are now distractions, which require sustaining capital investment, should be sold. And this is a wonderful market to sell gold assets in. Cerro de Pasco is a very different situation. What you have here is a very large silver resource, which isn't in production, where you need to look at the pathway to production. This is really a silver leverage story. Disclosure of conflict of interest. I own Cerro de Pasco. I'm a silver bull. I think that at some point in time, we're going to get a surprisingly strong move in the silver market, because that's what's happened in my lifetime during precious metals bull markets. And a very large deposit, a very certain deposit, a deposit where the pathway to production is fairly clear, could be expected in a circumstance like this to generate outsized performance. What could go wrong? Well, they need to either buy or build a mill. You need a bankable feasibility study around that deposit. The deposit is going to have variability in grade and metallurgy. That notwithstanding, you're talking about a deposit that in terms of size is gigantic. I love the leverage in Cerro de Pasco, but this is not one for weak holders.
Okay, so Equinox, you kind of hoped it would be better. A lot of this is going to rely on nameplate happening in Ontario, but you could see them, or you'd like to see them, let go of some of their lesser ideal assets, like maybe Los Filos. They've had nothing but trouble down there and trying to negotiate with that last
Ross
one.
Beatty's done this for years. Ross Beatty has started his companies with lower quality assets that were starved for cash, starved for attention. He's put cash and attention into them, tuned them up as he got cash from those assets. He used the public's appreciation of his efforts to raise money and buy higher quality assets. As he's bought those higher quality assets and tuned them up, he has sold the lower quality assets. I've watched him do this for 35 years. I know the game plan. I know him personally. We spend a lot of time together. He just needs to get it on.
Okay. And then Cerro de Pasco. I haven't looked into this one. You say it's a massive deposit and big leverage on silver price. How big is it?
Cerro de Pasco is a tailings project. Cerro de Pasco has been producing silver since before the Spaniards came to Peru. Wow. So for a very long time. The known silver contained in tails is something over 400 million ounces. The estimate of recoverable silver is over 400 million ounces. Note that they don't have to mine it. They just dredge it out of the tails, remill it, and recover that silver. So the mining costs and the capital costs associated with building the mine are very low. Your problem is going to be that these tails have been deposited over hundreds of years from several different ore types, so that within the deposit, the grades are going to vary, and it's not unlikely that the metallurgy is going to vary. You're going to have to do a very, very good job up front of sampling the deposit. You're going to have to design a mill with processing protocols that are variable depending on where in this disparate ore body that you are. That'll be a challenge. If I'm right, and we see a silver number with, first of all, a 5 handle and then a 6 handle and then perhaps a 7 handle, the public perception of those problems probably fades.
Yeah. Okay. So that's massive. So to put that into perspective from your tier one asset boot camp, if you get about 80 or 100 million ounces of silver, that puts you in a tier one, and this has 400 million. So we're like 4x that.
Well, I would say that for the tier one boot camp, 100 million ounces of silver probably puts you in strong tier two.
Okay.
Understand that we want minimally $10 million in situ recoverable reserves and resources, but we would prefer $20 billion in situ recoverable reserves and resources. Now, big silver deposits, well, in fact, economic silver deposits are extremely rare. So speculators can be a little more generous in the silver side. We've talked before, you'll remember the silver boot camp, where I think we were able to establish that the market capitalization of legitimate silver juniors is so small that when the generalist investor is tempted down into the silver space, there isn't sufficient market cap to handle the money. These are the most volatile financial instruments in the resource business. If I take myself back to the decade of the 70s, I remember the shares of Coeur d'Alene Mines going from 10 cents to $65. That's not a typo. I was too young, too poor, and too dumb to take advantage of that. But I also remember a wonderful small silver bull market that we had at the beginning of the 1990s. I remember Pan American Silver going from 50 cents, where we had the good fortune to underwrite them, to $45 in 6 or 7 short years. I remember Silver Standard Resources under Bob Quartermain's stewardship going from $72 cents to $45. The point of all this is that Cerro de Pasco is part of a fairly small club of legitimate silver juniors with reserves and resources exceeding 100 million ounces, where when the generalist investor comes down into the precious metal space, I should say if, not when, if the generalist investor comes down to the precious metals space, these things can exhibit almost unbelievable upside. The people who buy these things in good markets are not the people who attend the Rule classroom. These are people where if the silver price goes from $30 to $90 or $100, they believe that trend is going to continue on indefinitely. They are people who buy narrative, not fact. You need to be in these markets before they get there. They need to be your exit strategy.
It makes a market, and we'll need someone to sell it to. David Riley wants to know, Rick, could you please give your latest comments and ratings of Greatland Gold? And he says sold gold. I think he means SolGold, unless there is a sold gold. Okay.
Yeah, SolGold. SolGold temporarily appears stuck. There has been a lot of internal turmoil in that company. I'm not sure that internal turmoil is over. There are very high front-end capital expenses there, and there are ongoing political challenges in Ecuador, challenges which SolGold may or may not be able to solve. So I'd rather the jury be out. Greatland has had reserve and resource reconciliation difficulties. I still believe that that's a superior ore body. So I feel, I feel good about Greatland Gold.
Okay. And let's see. Tillman wants to know, says, Rick, you said that the mean portfolio allocation to gold is 0.5%. How do you monitor that? How could I check if that is changing and what the actual allocation is?
I don't know. What I said was that according to JP Morgan Chase, not Rick Rule, that the market share of precious metals and precious metals related investments in the US market was 0.5%, which is to say, if you added all the savings and investment assets in the United States, less than 0.5% of total private savings and investments is in precious metals and precious metals related securities. If you look back over 40 years, according to JP Morgan Chase, the mean market share of precious metals over 40 years has been 2%. So the statement was that if interest in precious metals returned and the market share wouldn't need to go to any dramatic place. It wouldn't need to be a circumstance where gold eclipsed the Dow or the death of the US dollar or any of that normal gold buck stuff. All that needs to happen is that we need to return to historical mean. If we return to the historical mean, then demand for the stuff grows fourfold. Remember that prices are set on the margin between supply and demand, not across the entire chain. I don't know what that would happen. I don't know what would happen to the gold price in that circumstance. I suspect I'll find out.
Okay. All right, Tillman. I've also heard the World Gold Council keeps track of it. I've reached out to them to come on my show and just never heard back and never followed up with it. But they said the same thing that you did, Rick. It's about I think he said 50 basis points. So yeah, same thing.
Yep.
Okay. Helen wants to know, is Ariana Resources still a hold? Is it cheap enough for the risk?
That company seems to have lost its way. The exploration potential of the Ecuadorian lowlands continues, but we haven't seen any exploration progress since the last conference. The other play in the company has to do with the continuation of the Hannon play, which is to say copper oxide silver deposits. And again, there, probably through no fault of Ariana, they've been unable to obtain drilling permits. This is in a fairly pristine part of the top of the Amazon basin, where the Amazon basin uplifts into the Andes. It's a very remote area, an area with very, very, very intact ecosystems and intact indigenous peoples. And the governments of both Peru and Ecuador have been very leery to permit exploration along the trends that are favorable for copper oxide silver exploration. So with Ariana, you have two spectacular exploration concepts. You have an absolutely brilliant explorationist. Keith Barron is a very, very, very bright guy. But you have a story that, at least in both of its major efforts, appears to be temporarily at least stymied.
Okay. Alrighty, and it looks like Helen, that chart we were talking about, Rick, with the CPI and maybe using like John Williams shadow stats, it looks like Helen might know how to do that. So her and I are going to get together and see if we can get that chart.
One of the nice things about the real classroom with 12,000 users is in any given task, it's virtually certain that somebody in the classroom knows more about it than you and I. My fondness hope is that this becomes a knowledge cooperative.
It's already happening. It's already happening. Yeah. So if you guys are watching this on Twitter or YouTube, we're pulling the questions from the Rule Classroom. So follow the links down below and submit your question for Rick. Okay, this was interesting. This is by Victor. He says, I wonder if the gold to silver ratio convergence argument may not be valid due to structural changes in the market. Basically, it seems like gold is actively being bought by central banks who are buying for macro reasons and are essentially price insensitive. Silver, on the other hand, seems to be more of an industrial metal now, so it will be affected by affordability of the industrial consumer. In other words, while silver may still have upside, it may not be as dramatic as gold. So the ratio right now is like 100 to 1 or something like that. What are your thoughts on that ratio?
I think the gold-silver ratio is a factoid. I think it's important only because the market thinks it's important. Think this through. People say that the ratio should be 16 to 1, which reflects the relative abundance or scarcity of both commodities in the Earth's surface, relative to 100 to 1, which is the price differential. But why should price be a function necessarily of supply or scarcity when it doesn't consider utility and it doesn't consider cost of production? With silver, as an example, about 18% of the world's supply of silver comes from silver mines. The rest comes as a byproduct of mining other metals or as a consequence of recycling. What that means is that the production cost around silver is a minor impact, a minor part of the supply demand equation. Look too at the massive above ground holdings of silver in private hands. Most of the gold that's held publicly is held in public hands, which is to say in government hands, but silver is controlled in private hands, which makes it much more difficult to measure. In my experience, industrial supply and demand in silver has been interesting, but the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence of overwhelming investment demand. That's happened 3 times in my life. I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. My experience has been that precious metals bull markets are led by gold. Eventually, and we're seeing that right now, leadership changes from the bullion to the highest quality gold stocks. Later, leadership changes to the mid-tier gold stocks. When the momentum in the precious metals markets lends credence to the precious metals narrative. And the generalist investor comes into the precious metal space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both. The generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent. But I'd pay less attention to the gold silver ratio. And I'd even pay less attention to the utility generated by silver in the industrial market. And I would pay much more attention to the traditional dynamics around investor and speculative demand in precious metals markets and the history of the price action in those markets.
Okay. It's the fear trade. I remember Jeffrey Christensen in your Silver Bootcamp going over the ratio and saying that he couldn't really find a way to play it. And after that, I kind of quit paying attention to it and trying to find some pattern. Okay, now Ross wants to know, please tell us what you think of Skeena buying some shares in TDG Gold.
I think TDG has somewhere between 30 and 40% of a very interesting new discovery. That discovery may or may not become a mine. If it does become a mine, I think Skeena wants to have a toehold in one of the constituents of putting that mine into production. If that deposit continues to develop, Skeena will be in a wonderful circumstance. They either can use that investment as a strategic stake to become part of the financial package to put that mine in production, or they can sell that stake to somebody else who wants to do the same thing. This is a very long-term game. The coals have been involved. Well, I mean, the coals were involved in the Virginia uranium business for 40 years before they finally wisely declared failure. The coals have been involved in Skeena for probably 15 years. These are very long-term players. The game that they're playing in the Tutagon, hence TD Gold, is also a very long-term game. This is a new discovery. This discovery is perhaps a mine in the making, but it's way too early to call it a mine. So people who are interested in something like TD Gold need to understand that between now and the time that there's any value ascribed to it by way of, say, a preliminary economic assessment or a pre-feasibility study is 3 or 4 years. Lots can go right, lots can go wrong. The Skeena guys are pros, and you need to decide if you're playing the game, whether or not you're a pro too. It's okay if you're not a pro, but you better be a patient amateur.
Okay. Bertman says, Steve, what are you referring to by our brokerage accounts? I'm simply saying that Rick's boot camps, if you take his advice, your brokerage account will thank you because the value goes up. And Jay is asking, okay, so asymmetric research, he's a member of the Rule Classroom, and he's been posting a lot on gold and uranium in his Substack. And Jay says, asymmetric research wrote an interesting piece describing how gold traded in the 1970s. They suggested gold can continue to run into a recession. They also suggest gold equities are cheap enough here anyway, pricing in sub 2,800 ounce gold. Any thoughts on that?
I agree with both of those. By the way, asymmetric research on Substack is free. That's a very good price. And I think they do very good work. There is an option on Substack where if you like the information that they give you, that you could pay them for it, which I would recommend. It needs to be sustainable over time. With regards to his assertion, I think the answer to that is yes and yes. We had a situation in the 1970s that was a very odd recession. It was stagflation, which is to say you had an economic slowdown that was accompanied by inflation too. Normally, recessions are caused by higher interest rates. In this circumstance, the recession was both a cause and an effect of the higher interest rates. That was a really interesting circumstance that I'm afraid we're doomed to repeat. The part of that assertion that I think is particularly relevant to today is that in the decade of the 70s, the absolute purchasing power of the US dollar, which is to say its performance against itself as opposed to some other currency, was that the dollar lost 75% of its purchasing power. It's not coincidental that in that circumstance, the gold price went up. The gold price held or more than held its own purchasing power. If we look back at the decade of the 70s, and we put on one side the 75% decline in purchasing power, and we put on the other side the 30-fold increase in the gold price, I think we can roughly dissect that. Not exactly. The move from $35 an ounce to, say, $100 an ounce was mostly a function, I think, of the end of price controls on gold, which is to say it was a coiled spring. When in this country it was at $35 an ounce, there was a gray market for gold internationally between 42 and 45. When the price cap came off in the United States and American demand met world demand, the price went from 35 to 100. The price began to, it is arguable, overshoot in 1974 into early 1975 when the gold price went from $100 an ounce to $200 an ounce. At that point in time, there was broad spread concern about inflation. Everybody wore these whip inflation now badges. Nobody did anything about it, but they wore badges. But Congress did something about it. They raised the interest rate. Well, the market raised the interest rate, and Congress and the Fed followed through. Fairly dramatic increase in the interest rate. That did two things. Well, three things, really. It tanked the bond market. It already hurt equities markets, and it obliterated the gold market. In 1975, the gold price declined from $200 an ounce, to $100 an ounce. Towards the end of 1975, looking at the bond market, looking at the housing market, looking at the equities market, the U.S. government blinked twice and reduced the interest rate. When that happened, investors understood what was happening. The game was on. And the gold price went from $100 an ounce to $850 an ounce in 6 short years. My suspicion is that past is prologue. Now, remember that at $850 an ounce, what you had was a circumstance where gold was overbought. Gold went from being unloved to being the only game in town. So I would suggest to you in the context of today's discussion that the real price of gold in the decade of the 1970s, before the overshoots, probably ran fourfold. In other words, the US dollar declined by 75%, and the nominal price of gold, probably mirrored that fall, probably went up fourfold. The move from, say, 400, 450 to 850, I think probably had to do with piling on. I think it had to do with people coming into a trade that had already established itself. We know that mean reversion is usually accompanied by overshoots. And my suspicion is that happened in the 1970s, and my suspicion is it may happen again. The bottom line now, however, is when I look at things, I believe in the period 2025 to 2035, that is to say the next 10 years, the US dollar probably loses 75% of its absolute purchasing power. Not its purchasing power relative to the Swiss franc or the euro or the Canadian dollar or the renminbi. I'm not talking about that. I'm saying for US dollar denominated spending, that the US dollar loses 75% of its purchasing power. And my belief is that it is likely, not certain, that gold mirrors that, which is to say that gold goes up in commensurate fashion with the purchasing power of the US dollar going down. Is this a trade that somebody should put their whole net worth in? Of course not. This is a contingency worth insuring. That's what it is.
Okay. Similar to 1970s, bonds, equities, gold's the answer. And David wants to know about silver. He's asking, can Rick comment on his latest views and rankings of Core and Hecla?
Both Core and Hecla can be expected to outperform, and I don't own either of them. Uh, they are both New York Stock Exchange listed. They both have very, very, very large constituencies. There is nobody more primed to hear good news than an existing shareholder, and they have large shareholder bases. They can both be expected to have better quarters as a consequence of recent acquisitions. So why don't I own them? Neither have good long-term track records of the efficient allocation of capital. And the acquisitions in both cases of Silvercrest and Gatos, respectively, were of assets that do a good job in current cash generation, but have very short reserve lives. If I had a better feeling for the ability of either company to utilize this cash flow to grow well, I would own them. But looking at their track record with regards to capital allocation over 30 years and looking at the fact that their increases in cash flow are temporary at best as a consequence of these acquisitions, I can't make myself own either of them. For traders, people with a technical orientation, I'm not one of those. My whole game is net present value versus price. For traders, these things are extremely volatile. And for people who are willing to divorce performance with value, for people who are willing to take that risk, these are names that you absolutely have to consider. That's not how I buy stocks.
Okay. Did you mean Gatos? Wasn't Gatos by First Majestic?
I'm sorry. Yes, First Majestic. I'm sorry. Yes. Yes,
Okay.
that position was First Majestic. You're correct. Absolutely.
Okay.
Silvercrest was my core.
Yeah, Silvercrest. I remember that. Oh, that was a fun run. We got into that one at $5 and sold at 11 or 13 or something.
Yep.
It was a good run. Okay, Michael, we're getting close to the hour here. Michael was asking about West African resources located in Burkina Faso. What are your thoughts?
I think West African may have run its course. For the next year or so. The political situation and the social situation in Burkina Faso continues to deteriorate. I think the social situation will begin to right itself. The new prime minister of Burkina Faso, although he's hostile to the mining industry, is also very hostile to Islamic terrorists. And I don't think that he's going to take the gentle approach that his predecessor did. In other words, I think they're going to deal with the internal turmoil in Burkina Faso in an extremely rough fashion. With the exit of the French and the influx of the Russians, I suspect that those Islamic terrorists are going to get a religious moment, not of the kind, well, perhaps they'll have the ability to become martyrs. I think, however, that the fiscal situation in Burkina Faso around gold mining and the ability of West African to finance the expansions that we were counting on, I think that's coming into some rough times. So I have sold my West African.
Okay. And we have, let's see, let's do one last one here. We haven't asked Kristen. Okay, Kristen wants to know, hoping to get Rick's ranking of Aris mining and his thoughts on their expansion efforts.
When I answer this question, I have both fingers and all of my toes crossed. I have Aris as a 4. I have known their management team for a very long time. I have been attracted geologically to Colombia for a very long time. I'm not naive as to the social and political challenges in Colombia. I won't waste your time with all of that, but it's a very rough place to operate. Their flagship operation, Segovia, is producing well. Their other operation, Marmato, is one of the damnedest gold deposits I've ever seen in my life. But it has, to be polite, extremely complex sociology. Dealing with that will be interesting. I have watched Neil Woodyer deal with complex social and political issues all through West Africa during the point in time when he built Endeavor from nothing to a spectacular, successful mining company. My only concern about Neil Woodyer, frankly, is that he's older than I. Neil cut his teeth when these deposits were being formed. And so that would be a bit of a challenge. But yes, I'm long Aris because of the size of the prize, which is enormous. I mean, I believe that these are each 5 million ounce plus deposits.
Oh,
I own the stock. I can't help myself.
okay. All right. And we are tapping on the hour here. Rick, do you have any final thoughts? Anything you want to leave our viewers with?
One more commercial. If you're in this business, you're in a gold bull market now. This thing that you've been waiting for all these years, it's here. It's time to get it on. You want to learn how to get it on? Tune in Saturday. If having tuned in Saturday, you don't think I gave you your money's worth, say, hey, Rick, give me my money's back. I don't think you're going to do that. In 30 years of money back guarantees, I've had to refund about 1/10 of 1% of the money I've charged. But we're here. We're in this gold bull market. Use it or lose it. Same thing with regards to the conference. We put these things on for a reason. Yeah, it's fun to make money. But the truth is that my whole team is proud of the fact that we put on the best natural resources investment conference on the planet. You're in a precious metals bull market. We are going to come into a natural resources bull market. Like I said before, use it or lose it. Invest in yourself. Learn how to take advantage of the situation that's here now. If for any reason you don't think we gave you your money's worth, we're going to give you your money back.
Awesome. I look forward to it. I will be there this Saturday and I'll be out at the symposium. All the links are down below. Rick, thank you again. This was a real pleasure.